Let me ask you something straight up. What if the next bull run already started, but it just doesn't look like anything you've seen before? No overnight explosions, no waking up to your portfolio tripling while you slept, no social media going absolutely crazy with Lambos and moon posts. Just a slower, steadier, more calculated climb. And most retail investors completely miss it because they're waiting for something that isn't coming back. That's not a scare tactic. That's literally what the chief investment officer of one of the most respected crypto asset management firms in the world is saying right now. And if you're watching this channel, you need to hear this before the crowd catches on. Welcome to XRP Financial Horizon, where we cut through the noise and give you the information that actually matters for your financial future. The person making this call is Matt Hougan, Chief Investment Officer at Bitwise Asset Management. Before we get into what he said, it's worth understanding who this man actually is, because context matters when you're deciding whose opinion deserves your attention. Hougan isn't a Twitter personality or a YouTuber running price predictions for clicks. He oversees investment strategy at a firm that manages serious institutional capital and has been one of the most visible and credible voices pushing for Bitcoin ETF approval in the United States. He has been publicly bullish on Bitcoin through multiple bear markets, not just when it was easy and popular to be bullish, but during the ugly stretches when most people were quietly distancing themselves from crypto. So when someone with that kind of track record and that level of professional accountability comes out and says the next bull run is going to behave differently than anything we've seen before, it's worth slowing down and actually thinking through what that means for your portfolio and your strategy. Here's the fundamental thing Hougan is pointing to, and once you see it, you'll start noticing it everywhere. The crypto market has always run on attention, investor attention, media attention, capital attention. And right now, a significant chunk of that attention has been pulled away by artificial intelligence. AI has become the dominant conversation in financial markets. Venture capital, hedge funds, pension managers, retail investors, everyone is trying to figure out their AI exposure right now. That is the trade of the moment in traditional finance circles. And what that means practically is that the pool of capital that might otherwise be flowing aggressively into Bitcoin and digital assets is getting split. Some of it is going into AI, some of it is going into tokenization projects, some of it is sitting in stablecoins waiting for clarity. The result is a market environment where recovery happens, but at a pace that frustrates people expecting 2021-style fireworks. That frustration itself becomes a trap. Investors give up right before the real move begins. Something important is happening inside the offices of registered investment advisors across the United States right now, and most retail crypto investors have no idea. RI. As are the firms managing wealth for high net worth individuals and large institutions. These are methodical, compliance-driven operations that do not chase hype. They run due diligence processes that take months. They build position frameworks around multi-year investment horizons. And according to Hougan, their interest in Bitcoin and crypto has never been higher than it is right now. Even during this downturn, even with prices significantly off their highs, even with all the uncertainty swirling around the market. But here's the nuance that matters. The way they're engaging with crypto has evolved. They're not just asking about buying Bitcoin outright anymore. They're asking about tokenization. They're asking about blockchain-based financial infrastructure. They want exposure to the technology through frameworks that their compliance teams, their boards, and their clients can understand and get comfortable with. That shift in how institutions are approaching this space is reshaping the entire market structure. There's a very human psychological dynamic at play in this market right now, and Hougan actually articulates it better than most. When prices are falling and nobody knows where the bottom is, investors, even sophisticated ones, instinctively gravitate toward things that feel grounded in reality, things that have obvious utility, things they can explain without needing a 20-minute primer on cryptography and decentralized networks. Stablecoins fit that description perfectly. A stablecoin pegged to the US dollar does something people immediately understand. It lets you move dollars across borders quickly, cheaply, and without a bank in the middle. Tokenization fits that description too. Taking a piece of real estate or a corporate bond and putting it on a blockchain makes sense to someone trained in traditional finance. It's just a more efficient version of something that already exists. Bitcoin's value proposition, while genuinely revolutionary, is harder to hold on to emotionally when the price is dropping and the news cycle is dominated by something else. That's not a criticism of Bitcoin, it's just an honest read of how human psychology operates under pressure. At the time this story broke, Bitcoin was sitting around $63,900, roughly 50% below its all-time high from October, down 26% for the year. The CoinDesk 20 index, which tracks the broader market, had dropped 34%. These are not minor corrections. These are the kinds of numbers that genuinely test people, that separate the investors who have done the intellectual work to understand what they own from the ones who bought in on excitement and are now questioning everything. But here's what Hougan's comments make clear. Price pain during a bear market does not equal fundamental deterioration. The interest from serious long-term capital allocators hasn't dropped, it's increased. The infrastructure being built in this space hasn't slowed, it's accelerating. The stablecoin market just hit a record high. Tokenization projects are attracting real institutional money. The bear market in price is not a bear market in development, adoption, or institutional engagement. Those two things are not the same, and confusing them is one of the most expensive mistakes a crypto investor can make. While Bitcoin headlines have been focused on price declines, something remarkable has been quietly happening in the stablecoin market that deserves a lot more attention than it's getting. The combined market cap of stablecoins just crossed $322 billion, an all-time record. For context, that figure is larger than the foreign exchange reserves held by 95 countries, including several that most people would consider wealthy, developed nations. This is not a niche experiment anymore. This is a globally significant financial instrument operating at sovereign scale. And the projections from Citi, a firm that has been in international banking for over 2 centuries, suggest this market could reach $4 trillion by 2030. That's not a crypto-native projection cooked up to generate excitement. That's a conservative, methodical financial institution saying that dollar-pegged digital tokens are going to become a $4 trillion asset class within 6 years. If that projection is even halfway right, the implications for blockchain infrastructure, payment rails, and settlement layers are enormous. Here's where the story connects directly to what this channel covers, and why the stablecoin and tokenization narratives aren't just interesting background noise, they're central to the XRP thesis. Everything being built in the stablecoin and tokenization space ultimately needs infrastructure. It needs fast, cheap, reliable settlement. It needs cross-border payment rails that can move value the way the internet moves information, instantly and without unnecessary friction. That has been the core argument for XRP and the technology Ripple has been building for years. The institutions currently deploying capital into stablecoins and tokenized assets are going to need settlement solutions at scale. And when they start asking serious questions about what the back-end infrastructure for a $4 trillion stablecoin market looks like, those conversations are going to lead right into the lane that XRP was specifically designed to operate in. The adoption curve for the payment layer follows the adoption curve for the assets being moved, and that adoption is happening right now. Tokenization keeps coming up in every serious institutional conversation about blockchain right now, and it's worth spending a moment on why this concept is hitting so differently in this cycle compared to previous ones. In past bull markets, tokenization was theoretical, a promising idea with limited real-world implementation. In 2024 and into 2025, it has become operational. Major financial institutions are actively tokenizing U.S. Treasury bills, money market funds, real estate assets, and private equity. BlackRock launched a tokenized fund on a public blockchain. JP Morgan has been running tokenized repo transactions. These are not pilot programs or press release announcements. These are live, functioning financial products operating on blockchain rails, built by institutions that manage trillions of dollars in assets. The fact that Hougan specifically calls out tokenization as one of the areas pulling investor attention and capital away from pure cryptocurrency plays tells you something important. This is not a fringe narrative anymore. It is a core part of how institutional finance is evolving. There was a specific data point buried in this story that I think tells us something worth paying attention to. While Bitcoin is down 26% on the year and the broader market is down 34%, Stellar's native token XLM has actually gained 8.9% this year. Stellar is a blockchain specifically designed for cross-border payments and real-world asset tokenization, which means it sits right at the intersection of the two biggest institutional narratives of this cycle. And the market is rewarding it for that while everything else bleeds. Now, this channel isn't about chasing XLM, but the pattern here is important. The market is already beginning to differentiate. Capital is already starting to flow toward blockchain projects that have verifiable, real-world utility and institutional partnerships. The early rotation is happening quietly, without fanfare, while most retail investors are still staring at Bitcoin's percentage drop from its high and trying to figure out when the old playbook kicks back in. Spoiler, the playbook is being rewritten. One thing Hougan is honest about, and I respect him for this, is that while his long-term conviction on Bitcoin is firm, he's genuinely uncertain about the short-term timing. He openly says he doesn't know if we've bottomed yet, and that we need to let the 4-year halving cycle play out before drawing too many conclusions. That's an important anchor for how you should be thinking about your own positioning right now. The most recent Bitcoin halving happened earlier this year. Historically, the most powerful period of post-halving price appreciation tends to unfold somewhere in the range of 6 to 18 months after the event. That window puts us firmly in the zone where patience is not weakness, it's the actual strategy. The investors who get wrecked in crypto cycles are almost always the ones who either sell into the bear market bottom out of frustration or chase the peak in a frenzy of FOMO. The ones who build generational wealth in this space are the ones who buy conviction, build position, and sit with it long enough for the cycle to do its work. Hougan's long-term Bitcoin call is $1 million per coin within the next 10 years. Let's think through what that actually means in practical terms for someone holding Bitcoin today at roughly $63,000. That's approximately a 1,500% return from current levels over a decade. From a traditional investment standpoint, a 1,500% return over 10 years, even if it's lumpy, volatile, and uncomfortable along the way, would be considered one of the great trades of a generation. And this isn't coming from a permabull with nothing to lose. It's coming from a professional investor whose firm's reputation and client relationships depend on the quality of his analysis. He's not hedging this call or wrapping it in a dozen disclaimers. He believes Bitcoin goes north of $1 million. What he can't tell you, and what nobody honestly can, is the exact path it takes to get there. That uncertainty around timing is real and honest. But the destination in his framework is not in question. Given everything Hougan is laying out, what does smart positioning actually look like in this environment? First, and this should go without saying but apparently needs repeating, panic selling into a bear market based on short-term price action is almost always the wrong move. Second, understand that this cycle is rewarding a different kind of investor than 2021 did. It's rewarding people who understand the fundamental use cases, payments, tokenization, stablecoin infrastructure, settlement layers. It's rewarding people who are allocating to projects with real institutional traction rather than projects with great memes and no fundamentals. Third, pay attention to where institutional capital is actually flowing, not where retail sentiment is pointing. When RIAs are increasing their engagement with crypto at the same time prices are down, that's a signal worth taking seriously. That's patient professional money building positions before the next move. And if you're watching this channel, you have the opportunity to be on the same side of that trade. There's a broader point underneath everything Hougan is saying that rarely gets stated directly in financial media, so let me just say it plainly here. We are in the middle of a structural transformation of the global financial system. Not a gradual upgrade, an actual structural transformation. Stablecoins at $322 billion and climbing toward $4 trillion. Tokenized assets from the world's largest financial institutions going live on public blockchains. Cross-border payment infrastructure being rebuilt on distributed ledger technology. Artificial intelligence reshaping how financial analysis and risk management work. All of this is happening simultaneously, and blockchain technology is embedded in the middle of all of it. The investors who understand this moment, who can see past the short-term price chart and recognize the scale of what's being built, are the ones who are going to look back on this period as an obvious opportunity. Not because it was easy, it was never easy, but because the signal was there for anyone who was paying attention. Here's where we land today. The next bull run is coming, but if you're expecting it to look like 2021, you're going to be caught off guard. It's going to be slower. It's going to be driven more by institutional adoption and real-world utility than by retail speculation and social media hype. And the assets that lead this cycle are likely to be the ones with the clearest connection to the infrastructure the global financial system is actively building right now. That's the message from one of the most credible institutional voices in this space, and it lines up directly with everything this channel has been tracking. If today's breakdown gave you something useful, share it with someone who's trying to make sense of this market. Drop your thoughts in the comments. Whether you agree with Hougan or think he's off base, this community is better when the conversation is real. Subscribe to XRP Financial Horizon if you haven't already. We'll be right here watching every move and breaking it down for you as it happens.